video, I showed you how to use this fundamental template to analyze NVIDIA, and I said I'll also be analyzing another stock as well. However, I thought I'd just split it up into two videos. So I've done NVIDIA in the last video, and I'm going to show another stock in this video. So the stock I'm going to cover in this video is something called NIO. It's a stock where a lot of people talk about it. There's a lot of hype on social media, etc. They call it the Chinese Tesla. So it's just one thing that I wanted, that I had a look at it in the past, and it's not something that I was really impressed with, but it's just more for the people that are interested in NIO, just to show them why, from my perspective, it's not a good stock to invest in fundamentally. So if I just start by entering all the details, so the ticker is NIO, and the sector is consumer discretionary. So you can see the overall trend over the last year is down, only recently is starting to come back up. The share price is $6 and the market cap is 11.5. I don't think this has updated yet. It's 13 billion or something like that at the moment. It's not got a PE ratio because it hasn't got any positive earnings per share. So the calculation just doesn't work. So they're not making enough money yet for a PE ratio. And if I look at the sector average for consumer discretionary, is 26. So let's write that down. So the next thing I would look at is the percentage debt. So let's search for NIO over here. And if I click on financials, so yeah, it's got a 13 billion market cap and it's got a negative earnings per share. So the first thing I would look at is I'd look at the debt and I'd compare that to the market cap. So if I do the calculation, that's 4.56 divided by 13.94, and I get 33%. So if I write that down here, that's 33%. So already you can see that the debt levels is quite high on this company. If you remember NVIDIA in the previous video, it had less than 1% debt. So you can see the difference. And even in terms of the market cap, I said that 10 billion and below is something I'm not interested in. This one's about 13 billion or 11.5 billion according to this. So it's not too far off what my cutoff is. So it's just things to be aware of. So far, I've not really done too much. I can see that the market cap is okay. The debt is quite high and it's got no PE ratio because it's not got any positive earnings yet. So that's one thing. The next thing is, let's look at the revenue. So if I scroll down, you've got the revenue. And to me, that's increasing. So it has got a positive revenue. So it's up. But one thing to note, can you see, if you look at the numbers, the net income, etc., is all negative. The net margins is negative as well. So if I next look at the net income, it's all below 1, so it's negative. So they're making a loss, this company, and over the last few years, down, further down, further down, further down. So the loss is just getting more and more. So that's down. And if I look at the net margins, so that's this orange line here, it's increasing, it's flattened out, but even then, if you look at the numbers, minus 38%, minus 29%, minus 29%, minus 34%, and minus 145%. So this company, I'd say it's going down. Although it's flat over here, it's still negative. So to me, it's down. And on average, it's about minus 30%. Then I'd switch to the quarterly, see how they're doing recently. So the revenue is up, is down. I'd probably say it's flat overall. So let's just put flat. If I look at the net income, again, this is pretty flat. So you got minus 700 million, 700 million, 700 million. So it's pretty flat, but it's negative. That's the most important bit. And then the margins as well. So you've got minus 30, minus 50, minus 30, minus 25, and minus 70. So the trend is pretty flat because it's up, down, up. So let's just say flat. And overall, let's just say minus 30 again. Yeah. Now, if I scroll down and look at the debt, so this red color here, you can see the debt levels are increasing. And if I switch to quarterly, I'd say that's pretty flat. And if I switch to annual again, and now I'm looking at the free cash flow, so this color here, negative, positive, negative, more negative, more negative. So overall, the trend is down, minus this one here. So it's negative. And again, if I switch to quarterly, it's got no free cash flow. So let's just say flat. The next thing is the gross margin. So if I scroll to the next page, so if I go to statements, and if I switch to annual, you can see majority of the stuff is less than zero. This company is making huge losses. So this light blue one is what I'm looking at, and to me that is increasing up until there, and then from here it's starting to come down. So the trend is negative. Trend is negative. And if I switch to quarterly, I'd probably say it's flat. The next thing is I'd see how if it's met its targets in the past. So you can see here, if I switch to annual, both of these, the EPS is actually been exceeding in terms of negative. So it's not something you want to see. So it's predicted only this much, but it's actually exceeded it in terms of negative. So it's made more loss than it's actually expected. So it's not something you really want to be looking at. This over here is probably the only anomaly, but overall that is not looking good at all. So it's exceeded it and missed it multiple times. So then the next thing you do, you'd switch it to quarterly, and then overall you'd see what this is, and it's been missing, hitting and missing. So it's missed quite a few times. So it's missed here, missed here, missed here. It's got it there, missed. So I think multiple misses this one. And the next thing I would do is I'd look at the revenue. So the same thing, but over here. Revenue is missing only slightly, but I'd probably say overall it's in line because it's not too dramatically different. And then if I switch to quarterly, 1, 2, 3, 4 misses. So it's missed 5 misses. So it's missed quite a few times. So again, multiple misses. Now going forwards, let's see what the predictions are. So this is going to get less and less negative. So it's going in a positive direction. So let's just say up. If I switch that to quarterly, again, positive direction. So let's just say up. Same thing for the revenue, positive. So let's just say up. Quarterly, overall is up. Then the next question is are they buying back shares? So for this, I would go to FinViz and I would search for NIO. And what I am making it annual. So I'm focusing on here, over here. So as you can see, for shares outstanding, this is actually increasing. What that means is they're adding more shares to the market. They're diluting their shares. So if you use supply and demand, they're increasing the supply by adding more shares to the market. And obviously the amount of shares you hold is still going to be the same. So they're diluting it, which is not good at all. So companies sometimes do this if they want to raise money, but as a shareholder, it's not something you want to be seeing because the value of the share that you hold goes down essentially. Now, if I switch this to quarterly, again, you can see they've been diluting it in the last few quarters. So they are diluting, shares are increasing. So they don't pay a dividend at the moment, so I leave this empty. The next thing to do is to look at the PEG ratio. So if I go back over here, and if I zoom out, sorry, and if I scroll to the top, you've got all the numbers here. And remember, it's not got a PE at the moment because they're not earning the money, so they don't have a PEG ratio either. So there's not really much, you have to leave that blank as well. Then you got the current ratio. So you've got 1.11. So your current ratio is greater than 1. So that means that your assets are greater than the liabilities, so it's okay. But ideally, you want something more than 1.2. So let's just say 1.3 as an example. That's good. So 1.1 is okay. It's okay. And if I look at a quick ratio, 1.01. That's also good. It's greater than 1, so it's good. And because it's a low market cap company, and the fundamentally it's not that amazing, as you can see from here, I'd say it's a very high risk stock. So the next two things to look at is the economic moat and the Morningstar fair value. So if I go on the IBKR and if I search for NIO, if I click on fundamentals, they're saying that the fair value is $7.6. And in terms of the economic moat, it's got none. So I'll just put that down as narrow. And because it's a high risk stock, I want a 20% safety margin. Meaning, I would, if you were following just Morningstar, then $6 would be a fair price to buy at. So what this goes to show overall, what this all means to you as an investor is you can look at all the analysts and everything, and if the analyst says $7.6 is fair, it doesn't always mean everything. If you do your own research and if you look at how much debt it's got and the trend in revenues, I mean, they're not even making money anymore. They're not making any profits. So yeah, they might make it in the future, but do you want to wait until that stage and just speculate that yeah, in the future they're going to make money? Or do you want to actually be in companies, quality companies that are already making money? Yes, you might not make as much money as NIO if it was to become big in the future. However, you're also protecting your downside. You're protecting yourself from making a big loss in case NIO don't hit their targets and they continue going down. So NIO is one of those companies overall. You can see majority of the things in this template is red. To me, that means just trade this with caution. Be very careful when trading NIO. And me personally, it's not something that I want to get involved in. I don't want to take this high of a risk. But for those that are watching, just be careful with this company. It's not to say that this company won't go up in price. I mean, in the last few days, I think it's gone from $5 to $7 or so. So it has done very good in terms of price recently. But sometimes you need to do your own research and manage your own plan and manage your own risk. And for me, this is too risky, unfortunately. So yeah, in the previous video, I've done an example of a good stock. In this video, I've done an example of a stock which I'm not too much of a fan on. So just be careful out there, because ignore social media, ignore what people are saying, do your own research. That's the main point I'm getting out to you.